Good afternoon, and thanks for joining us for our September investment webinar. My name is Charlie Lloyd, and I'm joined by, as ever, my colleague Wayne Nutland. The plan today, we'll spend about 30 minutes talking about and looking at sort of the main market moving events up until now. Of course, we've had a Bank of England meeting and rate decision half an hour ago. We'll touch on that later. And then Wayne will run us through some of the asset class returns, so the performance of equities and bonds and other investments we hold in our investment strategies, and talk about the outlook for them and how we see the rest of the year panning out. Obviously, without having a crystal ball, it's difficult to make precise predictions, but of course, we're paid and required to make those predictions and take risks on your behalf, and obviously manage risks as well. So firstly, I mean, if we cast our mind back to the beginning of the year, there was obviously a lot of focus on the Trump administration coming in at the end of 2024. A lot of excitement that US equities would continue to do very well because lots of Trump policies were very pro-growth. So cutting taxes, cutting regulation, generally being seen as positive for stock markets because they reduced, I guess, the red tape around businesses, enable companies to become more profitable. So there was a lot of excitement around US related assets at the end of last year. However, I think that was all undone very quickly at the beginning of April, the so-called Liberation Day. So the Trump administration and actually President Trump himself unveiled a range of tariffs to be imposed on trading partners around the world, including the UK. Now, some of the most severe tariff numbers were say for the likes of China, where the US feels somewhat aggrieved that the US imports a lot of Chinese goods, but the Chinese don't reciprocate. So I think the aim was to sort of address that imbalance. But of course, imposing tariffs is not necessarily the best way to do it, in our view, and certainly that was the view shared by stock markets, because you may have seen headlines back in April when we saw significant declines in stock markets. It was a very sort of painful week, I guess, if you were looking at equity markets each day. We were seeing declines of 4, 5, 7%, I think, on one day. And eventually, I think, or we think, what caused the capitulation of the Trump administration in the end was the fact that bond markets were having a bit of a tantrum. So, of course, we always focus on equity markets because they make up the majority of investment portfolios, certainly for the higher risk funds we manage. But I think what was more troubling for the Trump administration was that the bond market had a tantrum, and by that we mean US bond yields started to climb. Now, that was unusual because if you envisage a scenario where growth is likely to be weaker as a result of government policies, you tend to see bond yields decline in expectation of weaker growth and lower inflation. But what we saw was that we saw the tariffs being a sort of growth negative event, but borrowing costs in the US started to climb, and this panicked the Trump administration because for those of you who follow interest rates and the news around that, the Trump administration are very vocal at the moment in terms of demanding lower interest rates in the US because they think inflation is now under control, and you're starting to see the US labour market weaken, unemployment creep up. So they're very clear at the moment that the Federal Reserve, which is the US central bank, they're very clear that the Federal Reserve are what they call behind the curve. So the Trump administration is saying that the Fed should be cutting rates. They did actually cut rates yesterday, but again, the Trump administration have been calling for this for many months. So borrowing costs were going up back in April, and we think that's what caused the U-turn, a very big U-turn on the imposition of tariffs. Since then, we've had, I guess, some trade negotiations have occurred. And actually, you've now got the Supreme Court in the US getting in the way, in terms of they may actually deem the tariffs unlawful. They may deem that the administration have overstepped their authority. So we may be in a scenario in a month or two where there's no legal basis for the Trump administration to maintain these tariffs. So all bets could be off on that front. But as you can see from this chart, this shows the sort of 1 day percentage change in the S&P 500 index. That is the US stock market. Now, we saw a big sort of fall and a big recovery during the pandemic in 2020, and you can see that on the left-hand side. And then on the right-hand side, you can see the big fall and subsequent recovery during the April tariff uncertainty. So over the course of 5 years, it was the most significant moves up and down we've seen since the pandemic period. But I think if we fast forward to now, the impact of tariffs has been pretty muted so far. Now, for the US government, tariff revenue has increased significantly, as we can see by the chart. Tariffs are now making up a more significant proportion of total government revenue. And one of the aims of the Trump administration is to actually increase revenues. Again, like many Western countries, the US is running a rather large fiscal deficit. So tax revenues aren't meeting their ongoing spending obligations. So I guess one angle the Trump administration have taken is that if they increase tariffs, that would be a source of new revenue for the government. But broadly speaking, we've seen global trade maintained at levels we were seeing before the tariff announcements. We haven't seen or been close, we don't think, to a recession. Global economic growth has moderated in some regions, including the US, but again, it's still positive. Corporate earnings growth, again, very strong in the US and Japan. It's weakened a little bit in Europe and the UK, but nonetheless, still positive. And if you look at stock markets are trading at all-time highs, and that reflects the fact that corporate earnings have not only been sort of, I guess, unaffected by tariffs, but they've actually increased year over year. So thus far, the impact from tariffs has been fairly limited. A lot of speculation that we're going to see tariffs eventually reflect in higher inflation. So companies who are obviously paying these tariffs will simply pass on the cost of tariffs to consumers through higher prices. But the evidence for that thus far has been fairly limited. So the charts here reflect, or certainly the top chart reflects some survey data. That this is sort of a reasonable barometer for growth in the US. Now, manufacturing has been sort of, I guess, up and down. I mean, I think the key number to focus on here is 50. So 50 is, I guess, the line in the sand. A number above 50 suggests that there is expansion in that particular sector. A number below 50 means we're seeing some contraction. So as you saw, US manufacturing did go through a wobble earlier in the year, or midway through last year. It's picked up since, so it's trending around or slightly above 50. Services has been a lot stronger, and let's remember that the US's manufacturing base is relatively small. The US is a consumer-led economy, a bit like the UK. Services makes up a large proportion of GDP, so consumer spending, retail spending, and so on. So the services line is arguably what matters most to the US economy, and as we can see, indication that the services sector continues to expand. I think if we were to highlight one area of weakness in the US economy in recent months, it's the labour market. Typically, you see a spike in unemployment, and you see fewer jobs being created when you're in an economic slowdown, and eventually that leads to recession. But at the moment, if you look at the broad set of US economic data, most are trending sort of upwards and are broadly supportive of continued economic growth, and stock markets moving sort of moderately higher from current levels. But the one pocket of weakness, as I mentioned, is the US jobs market. And in recent months, it's It's weakened fairly significantly, to the extent that the Federal Reserve, which is the US central bank, they felt compelled to reduce interest rates yesterday, and they've indicated probably two more cuts to interest rates are likely to come through in the remainder of the year. Now that's contrasts quite significantly with the Bank of England, where today at 12 o'clock the MPC announced that rates would remain at 4%, so no change. That was largely in line with expectations. I think the difference between the US and the UK is that inflation in the UK is significantly higher than the US and is trending higher. I think, according to the Bank of England, inflation is expected to peak at around 4% this month, and trend down towards sort of 3.5% in the summer of next year. But clearly, the inflation problem in the UK hasn't been eradicated just yet, and that's really sort of forcing the Bank of England to hold still on rate cuts, even though you can make a pretty strong argument for the UK economy requiring some rate cuts to give a boost to growth. Now, this is a topical slide. I mean, in recent weeks, you would have seen headlines around UK borrowing costs and comparisons with the trust crisis we had a few years ago. But I think it's important to mention that rising bond yields, rising government bond yields, which obviously means higher borrowing costs for governments, it's not a UK problem. Now, this is very much a global issue. Government bond yields tend to move together. We have seen some, I guess, dispersion more recently, but generally speaking, we've seen some technical factors in the UK. So pension funds are not buying long-dated UK government debt in the same quantities as a few years ago. And of course, it's simple demand-supply dynamics. There's not much demand, there's plenty of supply, therefore prices are trending up. In Japan, we've had many years of very low interest rates and very low levels of inflation. Inflation's ticking higher in Japan as it has across the developed world. So again, Japanese bond yields have rebased higher. Again, not unusual in our view, given the very low starting levels. In Europe, France has got a very weak fiscal position, not dissimilar to the UK, and indeed the French government collapsed earlier this month. Another prime minister there. I mean, the main problem there is that they've got a big problem in terms of their fiscal position, spending far more than they're collecting in tax revenues. So some difficult decisions to be made on that front. And finally, Germany earlier this year. And one can make the case that the Trump administration's policies towards NATO forced the hand of the German government. But I guess in Trump's first term, he was very vocal that European members of NATO were not paying their fair share, were not paying or contributing enough into the NATO pot. And again, he's been banging that drum again earlier this year, threatening to pull out of the supply of weapons and support for Ukraine in the war against, or their defense against, Russian aggression. So Germany's hand has been forced somewhat. Germany have now released their debt brake. It was enshrined in their constitution that they couldn't let debt increase from historically low levels. That's been released. They've now committed to spending significant amounts of money, hundreds of billions on defence and infrastructure, again to improve the sort of resilience of Europe against foreign aggression such as Russia. So again, German bond yields have risen quite significantly because there's the expectation that they're going to be issuing a lot of new debt, borrowing a lot of money, and therefore investors require a higher yield in response to lending Germany that money. Just focusing on the UK market and UK bond yields in particular. As I mentioned, global government bonds have largely risen together, although in recent months we're quite open to the idea that the UK has fared perhaps a little bit worse. And that reflects the fact that the Labour government have had some difficulty cutting spending. Only a few months ago, they tried to make some reform to welfare and benefit spending. Backbench Labour MPs revolted, and the Chancellor was forced to go back to the drawing board and I guess dumb down those changes. So I think the market's taken the view that the Labour government have got their arm behind their back to some degree. They can't make or implement those difficult decisions about reducing spending. And I guess the conundrum the Chancellor now faces is that if you're not going to cut spending, you either have to increase borrowing or you have to increase taxes. Well, given where government bond yields are going, borrowing more money is becoming ever more expensive. So I think that's likely out of the window too. So as has been sort of flagged in headlines in recent weeks, we are going to see tax rises, tax increases in the November budget, the very end of November, we've now been told. And of course, there's various sort of policies being floated in the press, kite flying, as it's called. I mean, the obvious solution would be to simply raise income taxes across the board. That's probably the fairest way to do it. But of course, that would break one of Labour's manifesto commitments. I'd argue that we're past the point of Labour manifesto commitments, given how unpopular this government is. I mean, it's difficult to see how they could become more unpopular. But of course, instead, they're likely to tweak a number of smaller taxes in order to raise the type of revenue they need to do. So we'll have to see what comes through in the November budget. But the government will be very aware what the bond markets did to Liz Truss. And of course, if the budget is poorly received, you could see another sell-off in government bonds, known as gilts. And if we see government bonds spiking higher following the budget, then that will effectively be the market saying we don't like what we're hearing. We're demanding higher levels of compensation for lending the UK government money. So, yeah, difficult position, but they've boxed themselves into a corner, unfortunately, through their manifesto commitments not to raise any of the major taxes. So they're forced to raise a number of smaller taxes in order to raise the required sums. But for investors, of course, if you are buying government gilts or government bonds today, you are getting quite attractive yields. If you're buying a 10-year government bond, for example, UK government bond, you're getting a yield in excess of 4.5% per annum. And of course, it's what we call a risk-free asset because the UK government are unlikely to default and not pay you the capital when that bond matures. And a short note on the UK outlook before I pass over to Wayne. Now, clearly, the mood music in the UK is pretty poor. I think the media do a very good job of talking down the UK economy. But I think the main word I'd use to describe the UK in recent months and years is resilient. We've had obviously a very sharp increase in inflation in 2022 and 2023. We've had tax rises. And we've had rising sort of energy prices as well, which was reflected in those higher inflation numbers. The cost of sort of living and cost of going about your daily life has increased significantly. But despite all that, the UK hasn't slipped into recession. Economic growth has remained positive, albeit very modestly positive. But again, if you focus on the green line in the top chart, the services line, again, well above 50 and in recent months even trending higher. So despite everything that's been thrown at it, the UK economy has been remarkably resilient. I think if it hadn't been quite so resilient, I think the Bank of England would be more inclined to cut rates, even though inflation isn't back to its 2% target. But given that economic growth is reasonably positive, and actually in recent months inflation has been ticking up as well, I think that means the Bank of England are on hold. And absent a sort of a more meaningful economic slowdown and a recession, the Bank of England are likely to sort of hang fire until first or second quarter of next year. I think they'll want to see more evidence that inflation is declining. Of course, the problem with having a budget as late as the end of November is that obviously there's lots of rumours flying about in terms of what may or may not be delivered in that budget. And of course, for consumers who may be concerned about upcoming tax rises. They may be less inclined to spend money in the coming months, less inclined to move house, less inclined to make a big ticket purchase, such as buying a car. And of course, for businesses who, again, may be facing higher taxes, and certainly it may be more expensive to employ new workers. They may, in the short term, they'll probably put on hold any new investment. So again, in the short term, you've got this sort of difficult period of sort of 6 to 8 weeks where people are just sort of sitting on their hands until we're past this budget event. So in the very short term, you may see consumer and business confidence tick down. You may see some short-term weakness in the economy until we're past that end of November event. But all in all, lots of doom and gloom around the UK economy, but we're not quite as pessimistic. The UK economy has been remarkably resilient, and we don't think anything is going to fall off a cliff anytime soon, including the labour market, and we don't expect a sharp rise in unemployment either. Right, I've talked enough. So over to you, Wayne. You're just on mute, Wayne.
Sorry. Good afternoon, everyone. Apologies, I was on mute. Thank you for joining us today. Just to reiterate, if you've got any questions, do put them in the chat, and then we'll answer them at the end. I think we may go a few minutes over time, but we're happy to do that. I see a couple of questions have come through, so if you do have any more, do put them in the chat. We'll have a quick look at different asset markets over the next 10 minutes or so. So this chart here shows the returns of different asset classes over the year so far. On the left-hand side of the chart, we've got bonds, and on the right-hand side of the chart, we've got equities and commodities. So if we start off towards the left of the chart, we've got UK government bonds, US government bonds, and European government bonds. They've all delivered positive returns, fairly lackluster ones, apart from the US. We've been quite positive on US government bonds. We hold more in US government bonds than we do in UK government bonds in the Esprit funds, and that's kind of worked quite well this year, with US yields generally doing a lot better than most other markets. I just touch on the UK gilt return. It is positive year to date, about 2%. Which may be a surprise because we've heard a lot about bond yields going higher and things, and they have gone higher. But if we look at the yield move over the year as a whole, or the year so far, the yield move has not been that big. It's been a relatively modest move. And the other thing that's important to keep in mind when we think about total returns to government bonds is, unlike 4 years ago when the yields were very, very low, 0.5%, maybe 1%, we're now starting with yields of 4.5%. So even if you do get a somewhat adverse price move, you've still got that yield coming through, which is going to buffer your return quite a lot. Secondly, the UK government bond market, although it's still quite a long dated bond market, the sensitivity to interest rates is lower than what it was before. So we saw very weak returns from UK government bonds in 2022. The return this year has been okay. We haven't seen anything like as big a yield move, but because we're starting with those more attractive yields, that does support your price, even if you see some increases in bond yields. The next section along, we've got corporate bonds. So this is where, rather than lending to a government, we're lending to companies. And they've generally delivered pretty good returns this year, particularly high yield bonds and emerging market bonds. With high yield bonds, we're lending to riskier companies. So the interest rate there is higher. They weakened a bit during the tariff turmoil, but generally credit's been a pretty resilient asset class, and we continue to quite like credit. The next section is equities. I think this was also true when we last spoke in April, but if we look at the bar for the FTSE 100 and European equities, they've done better than the US this year, which is unusual, as you're probably all aware. For most of the recent kind of 5 years or even 10 years or so, US equities have done a lot better than UK and European equities, but that's not the case this year. I think when we saw the tariff turmoil, we did see people rotating out of US assets. Just prior to that, we saw some weakness in the mega cap tech stocks. They've largely rebounded actually, but the differential in performance between European and US equities remains in place, and this could be a relatively unusual year where European and UK equities outperform US equities. Finally, on the far right-hand side, you can see the big bar there, which is gold. and it's 29% so far this year in sterling. It's kind of distorting the rest of the chart a little bit. Another very strong period for gold. We think there are several factors behind this. Gold doesn't yield anything, doesn't have any profits, doesn't pay any interest, so it's always hard to kind of rationalize moves in the gold price. We think geopolitical uncertainty is certainly a factor behind it. Since the war in Ukraine, we've seen much greater central bank buying of gold as dollar assets have been sanctioned by the US. So we think central bank buying is a key part of that. And I think also general kind of worries about independence of central banks, perhaps inflation worries more generally. But certainly it's been another very strong period for gold. Okay, if we look at some of the asset classes in a bit more depth, I'm conscious of time, so I'll try not to take too long on these slides. Equities. So this chart here shows the performance of global equities in each of the calendar years shown below. So 20, 21, 22, 23, 24, and we've put 2025 in blue. As Charlie mentioned earlier, we saw some severe weak days during April, some of the weakest days we've seen since the COVID period. But the rebound has been very, very sharp. So we started off the year in April. By April, we were having the weakest year for global equities since COVID, but they've recovered quite strongly, and we're actually in positive territory now year to date for global equities. I think there's several reasons for that. We obviously saw a lot of negotiations around trade, but perhaps more importantly, as Charlie mentioned, the economy has broadly remained pretty resilient to tariffs. We've seen a bit of impact in goods inflation. There's been some weakening in employment in the US, but generally, I think if economists had been told that the economy would hold up this well despite the tariffs that have been impacted, they'd be quite surprised. So the economy's held up pretty well. Corporate earnings have held up pretty well, and we've seen this continued kind of boom in AI capex, which has been a real driver of US corporate earnings. Also, we've seen some interest rate cuts, and interest rate cuts are generally supportive for equity markets as well. So having had a pretty hairy start to the year, equities now looking pretty healthy year to date. Staying with equities, this chart shows estimates for corporate earnings growth. And we've got the US on the left, then the UK, and then Europe, and then Japan. And the blue bars show what the market was expecting for earnings growth this year at the turn of the year. The green bar shows what the market was expecting in April, and the kind of orangey red bar is what the market's looking at now. So if we take the US, for example, by the time we got to April, as those kind of tariff fears had come through, the market was really downgrading profit growth for this year quite a lot, but it's bounced back, in a pretty decent way now. So the market now looking for kind of 11-12% profit growth from US equities this year, and similar levels for next year. Actually, it's been less positive in Europe, which is interesting because we saw on the previous slide that European and UK equities have done better than US equities this year, which is true. But the profit backdrop has not been better. And you can see the downgrades we've seen in profit growth forecasts for the UK and Europe have carried on getting worse. So whatever the reason for this positive performance from UK and European equities, it's not due to underlying profit growth. So we'll come on to that again in a second. Finally, on the right-hand side of the chart, Japan. Japan's been a pretty good source of earnings growth over the last few years. There's been a kind of long-running shift to improve the profitability of Japanese corporates. A lot of Japanese companies had very, very low profit margins for a number of years. They still got quite low profit margins in a global context. But the government and the authorities over there are very keen to kind of boost those returns, and we are seeing that come through quite nicely in Japanese earnings. A bit more on equities. So, as I said earlier, European and UK equities have done better than the US, but the profit growth hasn't been better. So what causes that? Currency is one of the big factors behind that. So if we look at the top part of this chart, the black line and the red line show European and UK equities measured in dollars. Because the dollar has weakened, the pound and the euro have strengthened against the dollar. If you measure UK and European equities in dollars this year, they've done better than US equities. But the three lower lines show those in pounds and in euros, and actually the returns have been much more similar. So it's not really been about profit growth. The currency impact has been very important this year in terms of enabling UK and European equities to outperform US. Bond yields. So here we look at the key gilt yields for the UK government. So we've got the 2-year yield, the 10-year yield, the 20-year yield, the 30-year yield, and the 50-year yield. Obviously, the government borrows and issues bonds at various different maturities. Charlie talks about this causes a bit of a headache for governments because any new bonds they issue, they're issuing them at higher interest rates. So the interest is going to take up a bigger chunk of the budget. But for investors, the yield we're getting now is much more attractive than it was. The orange bar shows those level of gilt yields 5 years ago, sort of in the depths of the pandemic, or just coming out of the depths of the pandemic. They actually went negative for the 2-year yield. The 10-year yield, I think, got to as low as 0.5%. So bond yields now are materially stronger than they were 5 years ago, and they're even stronger than they were 10 years ago. So as investors in government bonds, higher starting yields are a very, very strong indicator of better long-term returns. Now, that doesn't mean to say you can't have a negative period of returns. You always can. The yield can always move higher. We could get a negative period of returns. But I think the outlook for investing in government bonds is much better now than it was 4 or 5 years ago, even though we perhaps worry a bit more now about budgets and about some of those bond yield moves. As I said earlier, despite some upward movement in yields this year, you've actually seen a positive return from UK government bonds, albeit not a particularly kind of impressive one. The next one, we look at corporate bonds. This is the last slide for me. You may be glad to hear. Again, with corporate bonds, we lend to companies. So we look for an additional yield over and above the government bond to reflect the risk of those companies defaulting and not paying the money back. This chart here shows the additional yield we get when we lend to riskier companies. So we call those high yield bonds. And the green line shows the size of that additional yield. And that's on the right-hand axis. So currently it's around kind of 3% more than we get for lending to governments. That 3% is quite tight historically. It's been materially higher than that in the past. We think there are good reasons for that. The corporate sector is in pretty good health. We heard earlier that corporate earnings are pretty strong. Corporate balance sheets are strong. So the additional spread we get for corporate lending is fairly tight historically. If we look at the blue bar, the total yield we get from lending to companies, in this case high yield companies, is around 7%. And we think in a multi-asset context, that's pretty attractive. When you've got US equity valuations, where they are historically elevated, we think areas of the bond market like high yield bonds make a lot of sense in a multi-asset context. Okay, I'll hand back to Charlie for some key messages.
Thank you, Wayne. That's very interesting as ever. So just to sort of recap on some of the things we've talked about, I know there's been lots thrown at stock markets this year. And of course, in recent years, we've had obviously this year the ongoing war between the Ukraine and Russia, geopolitical conflict elsewhere in the world, of course. We've got inflation in the UK rising once again, but of course we invest globally within the portfolios and strategies. We invest in some regions are faring pretty well at the moment, certainly the US and Japan in terms of corporate earnings growth. So really the driver of equity markets over the longer term are earnings, corporate earnings. But in very sort of short time periods, you can get geopolitical events and other risk events like obviously UK autumn budgets, which can impact sentiment and market movements in the very short term. Markets typically look through very short-term risk events unless they have a sort of major impact on companies or governments. The other point really, and I think I made the point reasonably clear earlier, there's a lot of doom and gloom around the UK, but the UK isn't unique in its challenges. In the Western world, there are issues, aging populations, and certainly weak productivity growth, especially true in Europe. But of course, there will be some solutions to those issues. And we're seeing that through this sort of huge investment in AI. And perhaps we'll touch on this subject in future webinars because it's a very interesting and obviously complex area to some degree. But certainly in terms of the UK's productivity problem, certainly AI is going to help areas such as healthcare, the NHS in terms of diagnostic sort of areas of healthcare and education as well. So lots of issues faced by the developed world, not just the UK. But of course, the UK stock market is pretty small as a sort of proportion of overall global stock markets. The largest market, of course, being the US, where most of our equity exposure is based. Any further questions? I appreciate we've run slightly over time. Any further questions, please pass them to your contact or advisor at Shackleton. They'll pass the question on to us if you wish to speak with us directly. Of course, we can facilitate that. My final sort of message really is that everything we've talked about today shouldn't be construed as investment advice. If you do have any sort of need for advice or guidance, please get in touch with your usual Shackleton contacts. Thank you very much for joining.